Hey folks, let's talk investing. I hope you're having a great day and ready to learn. Today, I want to talk to you about something that can change your family tree forever. Investing. I know, it sounds complicated. The folks on Wall Street use big fancy words to make you think you're not smart enough to handle your own money. That's a lie. You work too hard for your money to let it just sit there and lose value to inflation. Learning to invest is how you put your money to work for you, so one day you don't have to work so hard. It's the key to building real, lasting wealth and achieving financial peace for generations to come. Your income is your most powerful wealth-building tool, but only if you use it wisely. You can use that shovel to dig yourself deeper into a hole of debt, or you can use it to plant a money tree. Investing is how you plant that tree. When you buy a piece of a good company, you become an owner. As that company grows and makes a profit, your piece of the pie grows too. This isn't about getting rich quick. That's a myth that will get you into trouble. This is about a proven, steady process of building wealth over time. It's about securing a future where you are in control, not your bills or your boss. The good news is, you don't need a fancy degree to understand how to do this. All you need is a little bit of knowledge and a lot of discipline. The best way to get that knowledge is to learn from the masters, the folks who have been doing this successfully for decades. Reading is a powerful tool. It lets you borrow the wisdom of giants. Today, we're going to walk through 5 foundational books that will give you the confidence you need to start investing the right way. We'll talk about finding good deals, changing your money mindset, spotting great companies, and using simple, powerful strategies to win. All right, let's start with the granddaddy of them all, The Intelligent Investor, by Benjamin Graham. This book is the Bible of what's called value investing. Now, that sounds fancy, but the idea is incredibly simple. It's about buying something for less than it's worth. Think about it like shopping for groceries. You know that a gallon of milk is usually about $4. If you saw it on sale for $2, you'd recognize that as a great deal and buy it. Value investing is just applying that same common sense to the stock market. You're not guessing or gambling. You're looking for a bargain on a quality company. Graham's most important concept is the margin of safety. This is the secret sauce. A margin of safety is the difference between the real underlying value of a business and the price you pay for its stock. If you've done your homework and you know a company is worth $50 a share, but the market is panicking and selling it for $30, you have a $20 margin of safety. This buffer protects you from bad luck, bad timing, or making a small mistake in your calculations. It's the financial equivalent of wearing a seatbelt. An intelligent investor ignores his moods and only does business with him when the price is right. Next up is a book that changed the way millions of people think about money, Rich Dad Poor Dad by Robert T. Kiyosaki. Now, this book isn't a deep dive into stock analysis, and that's okay. Its purpose is to fix your mindset, which is the most important first step. Kiyosaki tells the story of 2 fathers, the poor dad, his own, highly educated but financially struggling father. The rich dad, his best friend's father, a high school dropout who became a millionaire. The book contrasts the lessons each dad taught him about money, work, and building wealth. It's a powerful parable about financial literacy. Once you have your mindset right and understand the importance of buying at a good price, it's time to learn how to find great companies to invest in for the long haul. That's where Philip Fisher's masterpiece, Common Stocks and Uncommon Profits, comes in. Fisher was a pioneer of what we now call growth investing. He wasn't just looking for cheap, bargain basement stocks like Graham was. Fisher wanted to find innovative, world-class companies that had the potential to grow their sales and profits for decades. He wanted to find the next big thing and hold on for the ride. Fisher's approach was all about quality. He developed a 15-point checklist to evaluate a company, and it had very little to do with the daily stock price. He was more like a detective than a number cruncher. He wanted to know about the company's management team. Were they honest? Were they brilliant? Did they have a long-range plan for growth? He also focused on a company's competitive advantage, what he called a moat. This is something that protects a company from competitors, like a strong brand, a unique technology, or a loyal customer base. He believed that finding a superior company was far more important than finding a cheap one. Fisher believed that if you found a truly outstanding company, the best time to sell it was almost never. The next time you think about investing in a company, don't just look at the stock chart. Do a little scuttlebutt of your own. Now, we've talked about finding cheap stocks with Graham, great stocks with Fisher. But what if I told you there was a simpler way that beats most of the experts? That's the big idea in Burton Malkiel's classic book, A Random Walk Down Wall Street. Bestseller for decades. It makes Wall Street understandable. Malkiel, a Princeton economics professor, says trying to outsmart the market is a loser's game, and he has the data. He's a big believer in the efficient market hypothesis. That's just a simple idea. The market is very good at pricing things correctly. All known info about a company, its earnings, its future prospects, everything, is almost instantly baked into the price. So trying to find undervalued stocks or timing the market is incredibly difficult when you're competing with millions. He says a blindfolded monkey throwing darts could do as well as experts. Because beating the market is so hard, he says, don't try. Instead, be the market. Do this via broad diversification and index funds. An index fund doesn't try to pick winners. It buys the whole index. It simply buys all the stocks in a major market index like the S&P 500, which is the 500 largest U.S. companies. You'll match the market's return with very little cost and very little effort. He wrote, "A random walk is one in which future steps or directions cannot be predicted on the basis of past history. Charts and patterns are mostly noise. The market is unpredictable short-term." Section 6. The Winning Strategy. The Little Book of Common Sense Investing by John C. Bogle. If Burton Malkiel opened the door to index fund investing, then John C. Bogle built the whole house. Bogle was the founder of the Vanguard Group, and he created the very first index fund available to the public. His wonderful book, The Little Book of Common Sense Investing, is a passionate and powerful argument for why this simple strategy is the single best way for most people to build wealth. He doesn't just suggest it, he proves it with decades of hard data. Bogle's main point is that investing is a zero-sum game before costs, but a loser's game after costs. But we don't invest for free. We have to pay fees. Fees to the fund managers who are trying to beat the market, trading costs, and other expenses. Every dollar you pay in fees is a dollar that comes directly out of your return. Bogle shows that these costs add up over time and are the single biggest reason why most actively managed funds fail to beat the market. The solution, Bogle hammers home again and again, is to own a low-cost, broad market index fund and hold it forever. You get to own a piece of hundreds or thousands of companies, so you are beautifully diversified, and the fees are incredibly low. This means you get to keep almost all of the market's return for yourself. It's a simple, elegant, and winning strategy. He famously said, don't look for the needle in the haystack, just buy the whole haystack. Folks, we've covered a lot of ground today. I hope you're feeling inspired and empowered, not overwhelmed. We've seen that you don't need to be a Wall Street wizard to build wealth. You just need to learn from the best and apply some timeless common sense principles. Ben Graham, demand a margin of safety. Robert Kiyosaki, focus on buying assets. Phil Fisher, look for high-quality companies with great leadership. Burton Malkiel, simple investing principles. Jack Bogle, low-cost index funds win for most investors. The most important thing you can do now is take action. Knowledge is useless without action. Don't try to read all 5 of these books by next week. That will just lead to paralysis. I want you to pick just one. If you're brand new and need the mindset, start with Rich Dad, Poor Dad. If you want the simplest path to investing, grab the Little Book of Common Sense Investing. Commit to reading it and taking one small action based on what you learn. That is how momentum is built. Building wealth is a marathon, not a sprint. Make a plan, be disciplined, stay the course for many years. I'd love to hear from you. What are your favorite investing or personal finance books? Share them in the comments below so we can all learn.